Good evening, everyone. Time for another silver update. This is the daily chart provided by netdania.com. You can click on the link below. And I have drawn in the key trend line, which we have just penetrated today. You can see the breakdown was right about 28.3 or 4, and we're clearly below that now. So although we're not below the 28 line, which does have some support here, really as far as the trend line goes, we've already penetrated. So we're looking pretty much at the next low would be 26. We could get a bounce in here because there is a lot of congestion in this area back here. So we could bounce at any point, but to be realistic, the next most likely point will be about 26. Then the next line I've drawn here is at 25, and that isn't really very strong. You can see there isn't a lot of price action. This move that came, the yellow line here, this move that came up through it, that was pretty much the first time we'd been there, except for this goes all the way back to 2008, the Bear Stearns high, and that's what this bottom line is, which is about 21.5 roughly. So that's going to be the absolute bottom, I think, of this move. Not ultimately necessarily, but certainly we would expect if we got down there, which I still don't think we will, but if we do get down there, it would probably be a violent rally back up to near 30, just because of the extreme nature of that move. But so we have penetrated this trend line, and we're waiting to see if we drop intermediately or down to 26.25, or the next point is 21.5. So that would be an incredible price for people who are stacking, and of course people who still have the confidence to stack, because a lot of people are now starting to get shaken out of the game. And that's really the way the game works. I wanted to take you over to the question of the night, which is kind of going to be the theme for the night as well. And this is from Viper99, and he says, "Dear Brother John F., I've read Prechter's Conquer the Crash, and on his advice last year, I pulled out all of my mutual funds and invested in GICs, Guaranteed Investment Certificates. They are guaranteed by the Government of Canada up to $100,000 per account. You purchase them from banks and lock in for 1 to 5 years. My question is, how do you know Prechter is wrong about deflation? He indicates cash is king, and metals, both gold and silver, are crashing with the stock market. I just started stacking, have 30 ounces, but have my life savings riding on cash is king. $200 gold and $10 silver would destroy me if I went all in like you suggest in your office series. Please respond. Crash for sure, but inflation or deflation? I'm confused." So, very good question. This is something that a lot of people are thinking about now, as we seem to be entering into one of these deflation scare scenarios that is being orchestrated by the powers that be, of course, for this very purpose. Now, you have to remember that your precious metals are always going to be a hedge against both inflation and deflation. It's very hard to see the hedge, the deflationary hedge, when you're on the way there. And the reason why is because they don't operate as a deflationary hedge until they become a default hedge. And when you're on the way to default, it doesn't appear what's going to happen. That's because default is a catastrophic scenario where all of a sudden debts are simply wiped out. So if you look at this projection, for example, let's look at $200 gold as the projection. So let's assume that this is correct and that we get a move that low in gold. We would have then, assuming that he's correct, we'd have a similar move in the stock market. which would give us about 1650 in the Dow Jones Industrial. So we would come down from about where we are, 12,500 now, to about 1650. Now, if we came down to 1650 on the Dow Jones Industrial Average, then you would be looking at a complete collapse of all pension funds, all mutual funds, probably all money market funds and everything. In other words, you'd be looking at a complete catastrophe scenario where most likely, even long before you got down to that level, you would see cascading defaults going through the system. Now, and that's the question. If you have your 100,000 per account, this is in Canada, but let's say it's in America or even FDIC or wherever it is. The question is if you've decided to put your money in cash, where are you going to keep that cash? And how do you know that once these cascading defaults happen, if they let that happen, that you're going to get paid that money from that person? So it's always tempting for the cash is king people to talk about how much they're going to be able to buy with the cash because prices are going to fall so low and they're going to sit there in cash. Well, unless that cash is in your mattress or unless that cash is buried out in your backyard somewhere, then it's very, very likely that the counterparty that's holding that cash for you, even if it is a government-insured bank, will probably renege on that. And even if that doesn't happen and you happen to be right and you manage to come out with the cash from your mattress, there's a very, very high likelihood that the government themselves will devalue the currency. It will be called back in. You could very easily take a 50% haircut on that cash. So, in my opinion, the precious metals, physical precious metals, are a much better deflation hedge than a bunch of cash stuffed in your mattress. So that's just my opinion. Now we're going to read an article that goes over something similar here. But first, I wanted to take a look at the prices that we have with the very, very rapidly sinking paper price. I wanted to look at some of the corresponding prices. Pulled up Tolving again just because this is a bulk metal and this is a lot of the others are starting to sell out. You can see here we're going to take a brief run through gold, and I don't think that gold is really as weak price wise as silver, but it does seem to be starting to sell out. You've got eagles are sold out there. There's also the maple leaves are sold out for gold. The kangaroos are sold out gold. Here's more eagles sold out, and I believe I saw the Krugerrands as well were sold out. So starting to see some gold sell out across the board. That's just Tolving. Now there's not really a lot of silver sold out at this point. Only the 40% bags. I don't think that's really important. I don't think too many people buy those 40% bags. Here's some monster boxes of eagles that are sold out. But otherwise, you pretty much have quite a bit of silver here. But when you look at some of these premiums, as the price is falling, these premiums don't really seem to be coming down. 275, I think, is pretty normal premium. But when you consider that we're looking at right now price of 28.08, and you're talking about a premium of $2.75, you're now talking about a 10% premium. And that's pretty high as far as relative percentages go. And some of these are even higher. So we want to look through and see if there's any that are better than that. Now here's one that seems to be pretty good. We've got open/sealed monster boxes of BU 1 ounce silver maples, and that's $1.49 above spot. So you're talking around $29.50 that you can get BU maple. So that's a pretty good price. There's also Buffalo silver round, 69 cents. So you're talking about $28.80 or so. you can pick those up. That seems to be a really good price. The other one was, if you're looking for bars, you can get these bars for 100-ounce bars, 49 cents an ounce over spot. And the 90% bags, those are coming up a little bit. They're a little bit over spot. But you can still get the 90% bags here that are their choice, dimes, quarters, whatever, for still at spot. So that's also a great price. So there's some great deals out there if you're willing to step up and buy. But of course, this is the time now where people are starting to get panicky. People always get panicky near the bottom. They always get giddy near the top. That's just the nature of these markets. That's the nature of all markets, and that's the nature of all investors. So now is the time for people who want to stack to begin stacking. I don't think this is a dramatic spike down. So there is a possibility that we may have a dramatic spike down, and you may be able to stack at a significantly better price than you can right now. So for those who are really patient and want a really good price, we may get a spike. We usually do get those at market reversals. So that's quite possible. You may be able to pick up silver for 26 plus spot or 25 plus spot. Plus premium over spot. So you may be able to get some really good deals here in the near future. But then again, it might just turn around and go the other way. So I want to jump over to another article that was over on Zero Hedge. And this is kind of arguing the same sort of thing that I'm talking about with the powers that be, really doing everything they can to try to discourage people from going into the precious metals. Of course, not only do the precious metals have the ability, if enough people piled into them, to just break their backs completely, but they also have the ability to protect you, and of course they don't want that. The larger number of people who are not protected by some type of investment that's going to weather the storm, then the less number of people they have who are going to buy into whatever scheme they come up with. So obviously the powers that be want everybody to be all in on the current system and then go completely bust and then be dependent upon them to come up with a solution. So, but this is from this is on Zero Hedge, and it's from Paul Brodsky. Very long article. I just wanted to read the end of it, and he makes some really important points. Piffle and baffle. Against this backdrop, Munger, Buffett, Bernanke, Geithner, Draghi, Lagarde, Rumpy, Obama, Romney, McConnell, Boehner, Reid, Pelosi, Kudlow, Krugman, Rubini, Wolf, Hilsenrath, Kernan, etc., seek to instill confidence among the factors of production and investors they influence. They are good and kind, highly intelligent, and well-intentioned, but so what? Collectively, they are wrong-headed. The fractional reserve banking system and debt money system they help sustain is directly responsible for the wealth and income inequality currently being experienced. When they yell at the mention of this assertion, ask them to disprove it. Promoting finance for the sake of financial return when it no longer produces capital cannot work. Arguing about taxes or austerity or budgets or infrastructure spending or political platforms is simply noise as more debt accrues and employment participation rates decline. What exactly is there to be confident about? And why should perpetuating confidence be the foundation for all centrist economic policies? People at all income levels and all political persuasions can no longer save their wages in the same currency it is paid. Are we to be confident that the real economy can expand when real wealth declines, or that investing our excess baseless currency back into shares of productive businesses denominated in the very same wasting currency will provide investors with lasting purchasing power? Are we to be confident investing in a system where government, mortgage, corporate, and municipal debts are priced at negative real interest rates because central banks, who will always have more money at their disposal then all the bonds outstanding, threaten to continue buying them if need be. We have met such authority figures, and yes, they are usually charming, smart, and dynamic, but almost always, without exception, it seems they confuse their theories, rationalized with econometric models filled with unrepeatable observations, for physical science. Confidence in productive assets may be more warranted than confidence in bonds and baseless cash, but this does not mean one should have confidence about future real production, wealth creation, economic growth, or the post-Bretton Woods monetary system. When the global monetary regime reduces to the solvency of one global banking system with interconnected, uncollateralized receivables as it does today, then its sustainability relies on the ability and or willingness of depositors to keep savings in the banking system, love those debit cards, and the willingness of the factors of production to continue accepting unreserved currency as compensation, and the willingness of capital holders to save and invest in it as workers, savers, investors, consumers, taxpayers, policymakers, and politicians. Why should we count on such unwarranted confidence to continue? It is within this context that Mr. Munger and others urge those curious about gold to start walking upright, to stop dragging their knuckles on the pavement. They counsel civilized people to reinvest their baseless wages into baseless shares of productive businesses selling goods and services in return for baseless revenues and earnings. Do not save in a relatively scarce form of money, they say, or imply, because saving starves creditors and leads to nominal output contraction. Again, it's not about nominal anything. It's about the purchasing power of wages, savings, and investment. Finance may be doomed, but commerce is not. Total global bank assets are about $95 trillion, and total bank reserves are not quite $10 trillion. This fractionally reserved global banking system does not necessarily imply immediate economic contraction, because there is no obvious catalyst that would force the leverage gap to suddenly close, though the JPM news just hit. However, substantial bank leverage in combination with already highly leveraged depositors, capital holders, and consumers are significantly retarding demand and real economic activity. There simply is no natural incentive for lenders or borrowers to leverage their balance sheets further, which in turn means that output growth and asset prices must continue to decline in real terms. And so we think it would be fair to caution against heeding the advice of a self-interested financial establishment trying to fit a flawed, unsustainable, and quickly deteriorating set of theories into what they would like us to believe is a noble and patriotic goal. The common good is not necessarily expressed accurately by past financial asset winners and the ambitious policymakers they support. Their barking is becoming more frequent, a clear sign that their baseless protestations and accusations are failing to turn the tide, not against squeaky pipsqueaks like us, but against fundamental logic, human incentives, and the mathematical power of compounding nominal debts. Don't worry, be happy. There's no reason to expect the demise of Western hegemony and no need to promote gold. Gold will be priced significantly higher in fiat terms over time, or next week, who knows, either by the markets or by an administered fiat devaluation. There can be no fiscal solution over any amount of time. Growth, austerity, or some optimal combination of the two can no longer work. The only way out is massive currency dilution, and we expect leaders across the political spectrum in all debtor nations to ensure that this occurs. We have no doubt the same misguided establishment will reverse course to save the day. They will ultimately choose to destroy the burden of repaying domestic debt through monetary inflation, a process that would reward the great majority of voters. They will choose this route because the alternative will be to keep exporting Western capital to developing economies and continued domestic unemployment. Krugman wins. By doing so, the West will have successfully shorted its currencies to export economies and will have received cheap imported goods and resources in exchange. The developed economies of the West will become more vibrant afterwards because the prices of goods, services, labor, assets, and liabilities will again reflect market clearing real delevered values. Nominal prices may be unrecognizable, but affordability across all income levels will improve. Debtor nations will wipe the slate clean, and their factors of production will again be globally competitive. The key to a successful transition is a credible monetary reset. Gold is the default collateral for money because it has a long and established precedent in this role. All that would be needed would be a fairly equitable distribution of gold among global monetary authorities taking place now, and an agreed upon exchange rate vis-a-vis baseless paper. It would have to be an exchange rate at which central banks could successfully monetize assets by tendering for physical gold with newly manufactured paper money, and an exchange rate high enough to attract enough gold to cover unreserved credit held in the banking system. It's a high figure. The relative cost of holding physical gold today is minimal. Above ground bullion or in ground bullion through mining shares against the negative real returns offered by the preponderance of financial assets in float. We suggest one keeps identities straight, invest with central banks, not against them, and consider the hollow rhetoric of the establishment that may temporarily suppress its paper price a gift. They are working for physical gold holders, not against them. Lee Quaintance and Paul Brodsky. So excellent article. Same point I'm trying to make, that this is again their deflation scare scenario. We can see it in gold, and they are trying to impress upon people by hauling out folks like Munger and Buffett and everyone else that you do not want to invest your money in physical gold, that's a dangerous proposition. Of course, the truly dangerous proposition is to leave your money in paper assets or cash, as Prechter would recommend, which either is, if this deflation scenario continues, which I don't think it will, but if it did, you would see either the counterparties for that cash evaporate, or the cash that you have stashed in your mattress would be devalued overnight, probably by 50%. So you're probably much better off hoarding and stocking precious metals if that's the deflationary scenario that you expect. Much better than cash. And we'll talk to you next time.